There's been a fair bit of chop in the prices of precious metals lately, and that's only to be expected. The short-term swings have been gut-wrenching and euphoria-inducing in equal measure. But precious metals was never a short game, and it's time for us to refocus on the big picture in the face of relentless volatility. For years, we've talked about de-dollarization, what it would mean for the US, the dollar, and of course, for gold. The trends were clear then, and they presented us with a logical roadmap. But we're beginning to see the consequences in action, and they affirm our earlier position that gold would emerge as a clear winner if trends continued. And in the midst of the government shutdown, a new related term has been slowly making its way into mainstream headlines. Institutions are now recognizing and trading on de-dollarization with a tailored strategy. They're calling it the Debasement Trade, and it's part of a long-term trend that we need to focus our attention to. Because whether gold or silver goes up or down next week, there's one likely outcome we can predict for the years ahead. If you're looking for stories about precious metals without the hype, you've come to the right place. Subscribing is a small but meaningful way you can help us continue this channel. Thank you. The word debasement has a history with money that goes back millennia. In the earliest civilizations, gold and silver were chosen for currency because of their physical properties. They didn't corrode or rust away, unlike metals like copper, a poor choice for storing value. The melting point was low enough and the cooled metal malleable enough that an ancient civilization could easily mold it with primitive technologies, and it was also rare enough that the supply was controllable. In today's world, if the government wants to print money to stimulate a part of the economy, they press a button. In days gone by, ancient civilizations would increase the currency in circulation by reducing the amount of gold or silver in the coinage. Instead of a pure gold coin, maybe it was only 90% gold, and the rest silver and copper. And instead of a pure silver coin, maybe it was mixed with lead. Reducing the amount of precious metal in coinage was known as debasement, and it allowed governments to expand the monetary supply. This is how an ancient civilization would create inflation, and the start of debasement usually marked the beginning of the end. Fast forward to modern times, and the debasement trade has familiar contours. Governments, particularly of Western nations, have lost control of their finances, frequently running deficits of 6% or more. To manage poor money habits, they debase their currency and increase the supply of money. Mismanagement of fiscal policy in this manner leads to inflation and all the problems that follow with it. Meanwhile, as the value of fiat currencies declines, the value of hard assets rises. Gold being a prime example and the main subject of the debasement trade. There's more to it than that, of course, but when an organization like JP Morgan decides to nickname a trading strategy in the public sphere, you can be sure of a couple things. First, they've already been trading on this. Institutions like JP Morgan don't reveal their trades before they make their moves and profit off them. It would ruin their advantage. So we could be confident this has been going on behind the scenes for some time. It's also a signal that the trading strategy is about to go mainstream. The evidence to support the theory behind this investment philosophy is abundant, and the crumb trail through history apparent to those who pay close attention. After the 2008 Great Financial Crisis, central banks around the world flipped from being net sellers of gold to buyers, as they watched the United States attempt to print its way out of a major banking crisis. In 2020, when the world shut down and the US turned again to money printing, rebranded as stimulus checks, central banks doubled their annual investments in gold, jumping from about 500 tons purchased per year to a little over 1,000. The US dollar has fallen to its lowest level in 25 years as a percentage of foreign reserves. Gold, which has been priced in US dollars for many decades, has risen in value as inflation eroded the dollar's purchasing power. As of today, gold is the world's number 2 reserve asset, surpassing the euro as a percentage of reserves earlier this year due to stockpiling and appreciation. Meanwhile, the Federal Reserve has abandoned its 2% inflation target and is accepting moderate inflation around 3%, and intends to continue cutting rates during an inflationary cycle, only making the problem worse. And as the dollar deflates in value, the prices of hard assets will rise. Taken together, these factors suggest the metals rally still has room to run, regardless of any short-term price swings. And that momentum is carrying the debasement trade. The trade could be characterized as a three-layer investment philosophy. The first is the macroeconomic backdrop, featuring higher-for-longer inflation, disrupted global supply chains, and the failing fiscal agendas eroding faith in fiat currencies and debt-laden nations. It's a setup driven by policy and market forces alike, and it's undeniably bullish for precious metals. The second layer of the debasement trade is geopolitical. As the world order shifts and global alliances realign, gold is emerging as a kind of neutral, currency-adjacent asset, a way to short governments themselves. Just as you might short a stock when you expect its value to fall, buying gold is a bet that the dollar's purchasing power will continue eroding. That's the wager central banks and nations are making as they watch the US strain under massive debt while weaponizing the dollar through sanctions. The issue isn't just that the dollar's losing favor, it's that it's losing trust. For decades, it's been the world's so-called safe haven. But when the risk-free asset starts looking risky, investors need a new place to store wealth. And there are very few real alternatives, gold being one of them. These first two layers form the foundation of the debasement trade, the big long-term drivers. But there's a third layer that's more tactical, more reactive. Precious metals still move with the tides of the market. They respond to headlines, shifts in margin requirements, rate cuts, and cross-currents in currencies and equities. Gold and silver are still connected to everything else after all. As those events unfold, pullbacks can create buying opportunities, while sharp rallies can give active traders a chance to take profits and enjoy the spoils. We said earlier the debasement trade is going mainstream. What that means is that big banks and big names are now advocating for a more aggressive gold position in portfolios. The traditional 60-40 portfolio, that's 60% stocks and 40% bonds, is being slowly replaced. In the past, if someone wanted gold in their portfolio, you would commonly hear that a 5 to 10% allocation was sufficient. Now, professionals in the industry are suggesting anywhere from 15 to 25% of a portfolio being built with gold would not be excessive. In hindsight, a 15 to 25% allocation would have served people very well. What does it say that banks and professional investors think a more aggressive position today is warranted? While the debasement trade begins to circulate mainstream news and investment circles, we should also keep our eyes on the developing supply constraints in the silver market. The debasement trade is heavily tilted towards gold as an investment asset, and silver prices do tend to follow gold's. So while the movement has some positive implications for silver investors, it's not the only major force we need to keep our eyes on. Silver has robust industrial demand, and it's not an easily replaced material. We are consistently seeing reports now that silver supply shortages are causing distress in London and Shanghai, and that distress is maturating in the form of higher premiums for physical silver and backwardation, where spot prices are higher than futures. Some recent reports indicate silver that was locked up in the United States is starting to make its way to the markets that need it the most. But whether that's enough to prevent a full-blown squeeze, or simply delays the inevitable, we can only wait and see. But if there's one thing we can reliably count on, it's silver riding the coattails of the debasement trade, regardless of the outcomes in the supply chain. And that's all we have for you today. Please remember to like, subscribe, and share with a friend. Thanks for watching, and we'll see you next time.